Welcome back to another video, team. In today's lesson, I wanted to break down what chart patterns are and introduce you to the ones that we use in our day-to-day trading. Chart patterns represent historical price movements of a security through graphical representations. These patterns can provide traders with valuable information about the potential future movements of a security. Chart patterns can be divided into two main categories, which are continuation patterns and/or reversal patterns. Continuation patterns suggest that a trend will continue in the same direction, and reversal patterns indicate that there is a change in direction, or in other terms, a break of pattern. Solely using chart patterns for your trading does not guarantee a 100% win rate, and it's important to note that traders use chart patterns in conjunction with other analysis techniques. There are various chart patterns traders can use, so be sure to familiarize yourself with all of them and choose the ones that you understand the most. Some of the chart patterns we'll be having a look at today include wedges, double tops and bottoms, and lastly, flags. Let's begin by breaking down the most common chart pattern, which are wedges. There are various forms of wedges, including a falling wedge, rising wedge, or a simple symmetrical wedge. Falling and rising wedges are reversal patterns where a normal symmetrical wedge can be a reversal pattern and a continuation pattern. Falling wedges are a bullish reversal pattern and is identified by two converging and downsloping trend lines. One trend line acting as a resistance level and the second being a support level. When using a falling wedge, your focus is to look for an upward breakout after failure to reach the bottom trend line. Following a successful breakout, price is expected to return to the highest point of the pattern. Now that you understand what a falling wedge is, rising wedges are simply the opposite. A rising wedge is a bearish reversal pattern and is identified by two converging and upsloping trend lines. Same as a falling wedge, one trend line acts as a resistance level and the other being a support. The difference is you are looking for a downward breakout at the support trend line. Following a successful downward breakout, price is expected to return to the base of the formation. Now that you understand the difference between falling and rising wedges, a symmetrical wedge works in a very similar way. Since the symmetrical wedge is both a reversal and a continuation pattern, we are looking for a breakout at either the support trend line or the resistance trend line to enter our trade. Moving on, we have our double top and double bottom chart pattern. Double tops are a bearish reversal chart pattern. The pattern is made up of two consecutive peaks or tops that are equal, as well as a neckline. After making the second top peak, you should see a reversal to the downside forming an M shape. When using a double top pattern, a valid entry would be after the second peak with a stop loss above the two peak levels. Once price has broken below the neckline, it's clear confirmation that price will see lower. Double bottoms, on the other hand, are a bullish reversal chart pattern. It is also the mirror image of a double top. It's characterized by two low points that are roughly equal in height and are connected by a trend line. Just like the double top, after the second peak, you should see the reversal to the upside forming a W. A valid entry would be after the second peak with a stop loss below the two bottom peaks. Last but not least, we have our bull and bear flags. The bull and bear flags are often viewed as a continuation pattern, indicating that the bullish or bearish trend is likely to continue after the consolidation period. Very similar to a wedge, both flags consist of two trend lines, one acting as support and the other being resistance. A bull flag is characterized by a strong upward movement followed by a consolidation period, which forms a downward rectangular shape. During this consolidation period, the security may experience some downward movements, but the overall trend remains bullish. Once the consolidation phase is over, price will eventually break through the resistance trend line, continuing much higher. Bear flags, on the other hand, are simply the opposite of a bull flag. This pattern is characterized by a strong downward movement followed by a consolidation period, which forms an upward rectangular shape. And just like the bull flag, the consolidation period may experience some upward movement, but the overall trend remains bearish. Once a breakout is confirmed at the support trend line, price is expected to see much lower. Now that we've shown you a few examples of chart patterns, it is essential for you to practice them through a paper trading account and find which one suits your style the most. Remember not to limit yourself to these examples, as there are various different chart patterns out there. With that being said, if you have any further questions regarding this video, please reach out to us through our questions channel located in the Discord server.